quite a bit on our agenda. Mr. Meng. Not yet. Not yet. There you go.
Thank you, Mr. Chair. So now we continue the second half of the board education program this morning. This is on global equity. So with that, I will turn over to Dan Bienvenu, the Managing Investment Director of Global Equity, to introduce our distinguished guest.
Thanks, Ben. Dan Bienvenu, MID of Global Equity. This morning, we're moving on to our second asset class overview. Recall, this is part of your series, the educational series as part of the board work streams. This is the second asset class we're covering. We covered fixed income in June, after covering in May, I believe it was, asset classes risk and return. This, recall, is work in partnership with the CFA Institute and the Council of Institutional Investors to build this curriculum over the past couple and the next several months. Today, it's my pleasure to introduce John Griswold, who is part of the CFA Institute senior faculty and has extensive experience teaching investment programs to pension fund boards around the country. So he has the unenviable task of following Hero, but believe me that John is here to really walk us through global equity and take a deep dive, and we are really fortunate to have him here as well. You have his full bio alongside with his slides, so I won't repeat what you have there, but needless to say, John is a highly respected leader in the field of board education on investment, so we're very grateful for him making the time also to come out and spend time with us and dig into the global equity asset class. Once again, we're hoping for a good, lively discussion. We think that it works better when it's done that way. So John and I also will be looking forward to questions and comments as we go through. And with that, I'll turn it over to Anne to kick us off.
Thank you very much, Dan and Ben, and of course John, for being here with us. My job is quite simple. It's just to recap where we are in this series of board education. You'll recall when the board went through its self-evaluation last year, improving education for each of the committees was one of the findings. And as Dan said, we are delighted to be working in partnership with the CFA Institute and with the Council of Institutional Investors. And we're walking our way through the key topics in investment, and following Hero, who I think has given us a case study, an example from a sister fund looking at these issues from a global point of view. We'll be looking at specific asset classes this morning. The other thing I want to just recap is what is the role of the investment committee as a committee of the board in relation to investments, because there's the day job of management, there's the role of consultants, but the board has a very particular responsibility. As Dan said, this is workshop number 3, part 2. We've covered risk and return basics. We then covered global fixed income, and today we're going to be looking at global equity. So this is our favorite slide to show whenever we're talking about investment, and it's the one thing that keeps us all absolutely focused on the job of generating sustainable returns for the pension fund. We pay pensions in dollars, and this is the CalPERS pension buck, and it reminds us that for every dollar for the, as Ben said, more than $20 billion that are paid out every year, 59 cents come from investments. So getting it as right as we can, getting as much luck on our side as well as skill, is going to be vitally important. And the role of the board in that is critical. And that's really what this education program is intended to do, help you fulfill your responsibilities more effectively. And so what are those? So the formalities of the CalPERS system, of course, the board divides up the job of overseeing the organization through a series of committees. And the way these responsibilities are set out is through what's called a delegation. And for the investment committee, there are important responsibilities conducting strategic asset allocation. As Hero said earlier, this is where the vast majority of returns come from getting those decisions right. And the board also has responsibility for selecting and overseeing performance of the board consultants. So what is the investment committee charged with overseeing? This is really the monitoring function that the investment committee has. Of course, investment performance, that goes without saying, but also a component of this is fund liquidity, the selection and performance of partners, managers and consultants, cost effectiveness, risk assessment, environmental, social and governance program, and the management of risks. So the critical word here is oversee. This is actually work that's done by management, and the role of the board is to oversee and hold accountable. So with that in mind, just as background, let me now turn over to John, who's going to take you through how to think about global equity and the role that it plays in our portfolio. So John, thank you.
Thank you, Anne, and thank you for allowing me to come and talk with you this morning. As Dan said, I've been doing work on helping investors do a better job for their institutions for a very long time. I've been a trustee of many boards, going back longer than I would care to admit, and on many investment committees. But I became early on fascinated with how the process of governance and of also managing funds affected the sustainability of organizations and really increased their ability to achieve their missions. I've worked in the nonprofit arena for most of my career in investing. I worked for 25 years plus at Common Fund, which was started by the Ford Foundation in 1971 as a nonprofit investment management company for endowments in the education field, mostly higher ed and independent schools. We did a lot of research over the years. We wrote a lot of white papers and even some books, and did a lot of investor education. Along the way, of course, meeting a lot of folks who were leaders in the industry, the nonprofit industry, including pension funds, has been a real education for me. That continues. A lot of my friends who've been friends for many, many years are still engaged in this work, and there is sort of a calling to it. It is hard to follow a fellow like Hiro, because in fact he embodies so much of what is being done today to continue the mission of these organizations that are vital to the future of their beneficiaries, whether they be a student, a healthcare patient, a pensioner, or any other charitable recipient of any service or financial benefit. So it's a remarkable industry, if you will. There's some wonderful statistics the Urban Institute puts out that nonprofits actually contribute a bit over 10% of the wages and salaries in this country. It is responsible for over 5% of GDP. The assets are $3+ trillion at last count, probably a bit more than that. But Americans give well over, almost, I think, over $400 billion to charities every year. So it's a very large industry. It's a large activity, providing the safety net in this country. So clearly, congratulations to you for the time you spend, the dedication you show to helping CalPERS do its part in benefiting its pension recipients, its beneficiaries. Let me start with a few things. By the way, I'd like, with Dan and Ben's permission, to ask that you ask questions along the way. I started as a teacher, actually, in Connecticut right out of college. And I learned very early that I wanted to know what my audience was thinking. And the only way you do that is to get them to ask questions. So please ask questions. We can try to answer them. I've got some extraordinary depth of knowledge here about CalPERS. I'll try to add a little overview, as Dan and Ben know, on the principles involved in global equity. Global equity, of course, is the largest single asset allocation within your policy portfolio. And we might as well go back to real basics and ask, what is equity? Equity is actually a piece of the corporate financial structure in companies. It is common stock or different kinds of stock. Could be preferred, could be warrants, could be depository receipts for those foreign investors. But it is really issued to raise capital for the operation of the company so that they can grow their business, expand their share. As I say, there are many types of shares, but they do allow the holder to vote, unlike the holders of debt. Some of you may remember my colleague from CFA Institute, Jeff Bailey, who was here I think a month ago, approximately, talking about fixed income. And we'll make some comparisons between equity and fixed again to remind you of that. But in fact, common stock is one of the lowest in the ranking of the capital structure, but it's a very important piece because it raises the most money in most cases. Issuing stock is obviously ownership in the company. You are participating in the growth of the company, unlike fixed income holders, and you're, by extension, participating in the growth of the economy as the company grows as part of a growing economy. And that's true globally. That's why there is an allocation to global equity in most large institutional funds, because they wish to participate in the growth of the global economy. And that has happened over many, many years. There'll be some other slides where I'll talk a little bit more about that. One of the things that, of course, you get to do as a common stockholder, other stockholders to some extent, is to participate in the voting about corporate issues, corporate concerns. And that's when it comes to ESG or any other issues, compensation, you can think of a lot of them. There are tremendous opportunities for shareholders to influence that. And in this country, of course, we've seen a continual concern. When I work with the CFA Institute, which I think most of you are familiar with, if you're not, please ask a question about it. But I am not a CFA charter holder myself, but I'm a member of a committee which is called the U.S. Advocacy Advisory Committee, USAAC, and it's one of several committees around the world that the CFA Institute has developed, has put in place to pick up issues from the local countries, regions, and bubble them up to the senior staff and to other important people working with CFA Institute to do advocacy to the regulatory authorities, SEC, FINRA, et cetera, Labor Department, and to promote best practice and ethical behaviors and good behaviors, basically, for the investment industry and for generally asset owners as well. So a lot of the work we do, we have meetings and discussions during the year. We meet once a year for sort of a plenary retreat meeting in Washington. And a lot of all the members, most of them are CFAs, except for me. I do feel honored to be a part of that. But in fact, those local society members bring their issues to the table at those retreat meetings. And then the senior staff and other important advocates for the changing some of the regulations, some of the laws, some of the practices, do their work on the Hill or with the SEC. We have the SEC come in and talk to us about what they're doing. And in fact, I think it's an opportunity for, as Hiro said in the earlier session, there is an opportunity to be heard. And particularly if you're a large asset owner, of course there is, because people tend to listen to us. But even as a local CFA person who's working in a local advisory firm or a bank, any number of different types of jobs, they can be heard through the work of the advocacy committee. Very important, I think, for the benefit of the asset recipients, eventually, the beneficiaries. A lot of the work we do has to do with things, with issues such as Could move on. Yeah. Well, a lot of the work we do is talking about the very things that Hero was talking about earlier. How to integrate ESG into portfolios and how to get more value out of the management of funds. And he's a good, as I say, he's a good embodiment of some of the things that we talk about in that meeting. Let me move on. As suggested, I'm a little windy sometimes. This is a chart which shows the U.S. share of GDP, and really what we're talking about here is the rationale for going global in your equity allocation. U.S. share in the 80s was over 35%. Now it's under 25%. What does that suggest? Well, clearly, if you're only invested in your home market, and there's a feature in most portfolios called home bias. Investors traditionally, long going back many, many decades, have invested traditionally mostly in their home market because they felt more comfortable and they understood the home market, but also because they were perhaps a little risk averse. They may have been a little fearful of going abroad. And in fact, up until just the last few decades, really starting in the 50s and 60s, investing abroad was difficult, was much more expensive, and the results were sometimes uncertain, partly because the regulations in the countries abroad were not clearly understood, or they were adverse to investors from outside their own countries. So that has changed enormously. Yeah.
Yeah, I would like to add one comment here. So, in addition to the percentage of GDP, global GDP, there's another layer to it. Is also how deep the capital market is, because the depth of capital market is not always positively correlated with the GDP share. So, for example, China's GDP is the second largest economy, but the capital market, the depth of the capital market is not the second deepest in global capital markets. So, just we always have to keep that in mind.
Mm-hmm. Yes, the U.S. share of the capital markets actually is 55% now, approximately. So our market is very deep, it's very large relative to any other market in the world. And in a way, you almost hope that shrinks over time, because in fact, then it will be a byproduct of those markets that are large now, getting larger, but perhaps the depth and breadth of those markets will cause those markets to be more acceptable to investors around the world, and including Euro's fund, and of course funds across Europe and others in Asia that are beginning to really grow enormously, sovereign wealth funds included. So let's move on here. Global equity allocation is really the ability to invest anywhere in the world. It isn't that you're in your home market and then you add an international component. A global investor is able to go anywhere, invest anywhere, and typically they are broken down into three components: U.S. investment, of course, for a U.S. investor, plus international developed market stocks and emerging market stocks. This is a sort of the three-legged stool of global investing. And of course, those categories will change over time as markets develop, countries become larger because of their own internal business development and the size of their capital markets. This is a chart that was developed by actually a friend of mine, Elroy Dimson, when he was at London Business School with two other academics. And it was a book that was called Triumph of the Optimist. It was published in 2000. It was a fascinating book, but basically the idea was that the optimists who invested in equities won over investors in other asset classes, basically over fixed income or anything else, real estate, what have you. And that was because of the growth of the economies, the growth of the stock markets, the growth of the companies they invested in. And so that over a period from 1900 until 2000, when the book was published, they looked at, I believe it was 19 markets originally, now it's I think 23, and they scoured the world for markets where you had a very long history, a very long data set of equity returns that they could produce these numbers from. So this shows you going back in many countries, most of them developed countries, there's most of Europe there, some outside, New Zealand, Canada, and obviously the United States. But this is almost 120 years of data on how equities have beaten fixed income. And in fact, it is a great example of what we're talking about and why you invest in global equities. So the traditional rationale is several-fold for investing in this asset class. Obviously, we all probably know that diversification, multiple asset classes, low correlations, hopefully, between the various asset classes and strategies, does provide a lower portfolio risk overall. If you think to the traditional rationale for investing in private equity or private capital generally, venture capital, other things, is that you're lowering your portfolio risk even though you're putting individually risky asset classes or strategies together. So global equity is the same thing, but in a slightly different way. Diversification regionally, geographically, is really lowering your portfolio risk. You're capitalizing, as I said, on global economic growth. You're increasing your breadth of opportunities for the portfolio manager, including looking for market inefficiencies. The Holy Grail is to find dislocations and inefficiencies. That's Ben and his staff's job, and that consumes them all the time. Where do we find inefficiencies that we can exploit? And of course, you're taking advantage of market cycles. You can vary your portfolio weights depending on the region or the individual country, or even the sector of the industries that you're looking at from the investment standpoint. This, on the other hand, shows you a long-term look at when the U.S. has beaten international. So if you take the global equity universe, you break it down between U.S. and non-U.S., this is what you see over a long period of time. This goes back to the 1970s. It shows you those cycles, and more recently, of course, the U.S. has outperformed international for the last 10 years. We heard that from Hero and from others. But you've had times when valuation of a particular, of either the U.S. or the international got up to a point where it was apparently too high. People felt there was not much value to be gained in continuing, so they shifted back to the other group of investment markets. And in fact, so you have a swing. We're wondering right now, because the U.S., by many measures, is fully valued or even overvalued, depending on which measure you're looking at, the cyclical Cape-Shiller measure index being one, or the ratio being one measure. A lot of people saying the U.S. is overvalued versus international, and international, thus, is undervalued versus the U.S. So will there be a shift? We don't know. Nobody has a crystal ball. It's existed longer than we know. And I was fascinated by Hero's statement that the end of last year was the first time in his experience that everything went down. So perhaps something has changed, and we aren't going to see quite the rational shift that most of these changes between the U.S. and international would illustrate, that people see overvalue, they get out of that asset class, and they go into a different one. Questions on any of this so far? This is fairly basic stuff, I know, but I think it's good to take a step back sometimes and look at your allocations and what are the qualities of what you're looking for. And you, as a committee, as a board, as Ann said, have the responsibility for monitoring your staff, but also just asking good questions, tough questions of anybody who's talking about this.
No requests so far? Oh, just nope. I say that. Ms. Yee.
You knew that when you said that.
Every time.
Thank you, Mr. Chairman. So I wanted to just get your perspective about whether there may be an opportunity for, I guess, heightened attention on emerging markets, given obviously the volatility that we're seeing with respect to the other buckets, and or has there just not been enough progress with respect to those countries and certainly those opportunities with respect to expecting that we could get outperformance in the near term?
I think as a group, emerging markets is very varied, first of all.
Yes.
So there's no one answer. Emerging markets contains China, which a lot of people find quite odd, because China is now the second largest economy in the world. Some think it, on a purchasing power parity, it's the largest. But in fact, it is, in general, emerging markets have always been more volatile, partly because they go through a much more, if you will, dramatic economic cycle, and that affects their security prices. They're also subject in many cases to the trade imbalances or trade hiccups that go on. The old expression, the U.S. sneezes and everybody gets cold in the rest of the world, but that's particularly been true of the emerging markets that are very dependent on trade, and partly because they're very dependent on the commodities that they produce. They're smaller markets in many cases, so they don't have the clout or the consistency, and many of their markets are very thin from an equity standpoint. Ben, you want to comment further on that? I'm sure you have some good insight.
Yes. So exactly as John just said, that the definition of emerging market is very broad. As John mentioned, China is considered as an emerging market, so is Singapore and South Korea, and then compared to other emerging market countries. And then in emerging market investment, we deal with additional layer of risk, such as the instability of the political system, regulatory bodies, currency. As you know, the currency has been very volatile market. So these we all have taken into account when we look at emerging market investment opportunities in emerging markets.
And I think the only thing that I would add to that is just that when you look at this cycle of outperformance, if you put up here international X, or actually like emerging markets, so international X emerging markets, the outperformance of the U.S. is even more pronounced, and largely that's due to the dollar. Now, the other side of that, and remember that we're not looking in the rearview mirror, we're looking forward and trying to think about our allocation. The reality is that emerging markets are cheap. Now, are they cheap and getting cheaper from a valuation standpoint? That's, as John said, if we had a crystal ball, that'd be really helpful, but we don't. But it is the case that from a valuation standpoint, their valuations are relatively low, and certainly they are a portion of our benchmark.
Right.
Yeah. And also when we look at emerging market, we also had to be mindful. Some people can break down emerging market by commodity. Are you importer, net importer, net exporter? Then the super commodity cycle plays a bigger role. For example, Brazil is a commodity exporter. India and China mainly a commodity importer.
Right.
So depending on which part of the commodity, so commodity one way, and overall are a net importer or exporter. So emerging markets tend to be net exporter. So they are exposed to the global economy, the volatility of the currency, the commodity cycles, the instability of the political system. So there's a number of additional layers we need to consider, and that's why, as John mentioned, tend to be more volatile than developed countries.
Very often, you're looking at the risk side rather than the return side when you're looking at emerging markets, because the risks, as Ben said, can be multifaceted, much more so than a much more developed, settled market. And so that contributes to the volatility, because those people, there's a bit more emotion in there. If there's any fear and greed will work against each other more violently. If any worldwide event happens, like 08, 09, and so you see tremendous volatility. Just an anecdote, when we were starting an emerging markets fund many years ago at the firm I worked for, we warned investors that while the return over many times will be volatile, if you have to be a long-term investor, really long-term, I'm talking 15, 20 years, to really realize the steady growth of the economic improvement in that sector. And indeed, that has proven to be true. So you're seeing this tremendous variation, volatility, standard deviation, or what have you, and hopefully it doesn't panic an investment committee and pull out of that just the wrong time. And that's one of the things that we teach university boards, or the longest horizon investors. Use your long-term horizon to your benefit. And that gives people a little thought, something to think about, particularly. And pension funds are some of the longest yours is a perpetual fund too. It is a huge advantage when you can ignore the volatility and the panic of other investors, because you can benefit from that occurrence. Let's move on here quickly. Let me make sure I state what this chart is. It is a U.S. versus international equity. So if you put them again together, they make the whole global equity pie. But it shows you the difference in volatility. These are rolling standard deviations of monthly returns from 1970 on your far left. Let's say 74 there, so I'll say it's 74, to the end of 2018. And what it shows you is that individually, the international and the U.S., the volatility is quite high, but if you put them together, that's the green line. That shows you that together, makes my point that I made earlier, your volatility is actually reduced most of the time. Not always, but most of the time.
We have another question, Mr. Jones.
Yeah, thank you, Mr. Chair. Yeah, back to the general statement about global equities, and I don't recall what that number is, but over some period of time, the number of public companies where we have access to global equities have been decreased by some 40%, as I think I remember a number. Mm-hmm. And so my question is that looking at our long-term philosophy, do you think that decrease in number of public companies where we have access to global equities will continue to decrease? And if so, what kind of thoughts you have about new strategies to deal with the ever-decreasing number of public companies in the marketplace?
It's interesting. I appreciate your question. I think Ann might be able to shed some light on that too, because I think you've thought a good deal about that as well. But let me just say, it's one of the issues that this U.S. Advisory Committee that I'm on, CFA Institute, has been wrestling with. There are various theories about why that's occurring and what the ultimate result will be, if you will, for investors. Clearly, it is disturbing to see that, but what seems to be happening, at least in the U.S., which is really more easily seen, but it's probably to some extent true in all developed markets, is that companies feel it is more profitable to be private, to go private, or given the activity of private equity and taking companies private, has produced this over time. And in fact, it has reduced the breadth of the market. There's no question. The options are not easily taken on because you don't want to be regulating something where there'd be lots of unintended consequences potentially. So, Ann, what's your thought about that too?
Yeah.
Sure,
thank you very much.
Yeah.
It's an excellent question. CalPERS sits. I represent CalPERS, sitting on the SEC's Investor Advisory Committee, and we had hearings on this topic last year. It's a global phenomenon. I think that's one thing to note. And I think there were two lessons that came out of the hearings. One is that the abundance, the supply of finance in private markets means that companies don't need to go to an IPO as soon as they might have done before. So they're staying private longer, and more of their growth is happening in private markets. And for many companies, going public is a way to monetize incentives, in other words, options for the inside team, for the management, and also to give an exit for the first and second round funders in the private markets, because the venture capital and the private equity industry, they need the public markets because they need a place to go. They can have trade sales through private market deals, but the public markets really matter for the private markets. So that whole issue of what are the public markets there for was really center stage in the discussion. Another issue was about the rising costs of listings, which have gone from, modest amounts to several $1 million, and that's felt to be a burden. And then there was also
regulation as well.
There was
that's part of the cost.
the listing costs are an item in their own right. And you'll recall that there was some efforts to lift the regulatory burden by giving exemptions to, certain rules and regulations to have a lighter touch. But that doesn't seem to have been followed by a surge in IPOs. So there's a real interest in saying, okay, what's really going on in the wider economy, taking the United States as the example. So the need for finance has diminished. The type of industry, there's been a huge transformation. And that in itself means that financial capital is playing less of a role in company value. I'll give you one data point that we were very struck by. 30 years ago, the S&P 500, which is, a very important index, on the balance sheet, which is one way to value a company, 85% was fixed assets. So fixed assets 30 years ago were really important. Fixed assets are expensive. I mean, about kit and equipment and land and inputs and all the physical things that could be valued on a balance sheet. Fast forward to now, 85% of the S&P 500 balance sheet is what's called intangible. That means brand. That means goodwill. That means human capital. And so one of the projects that's come out of this SEC work is actually looking at what is the reporting regime that we need now to start capturing the value that's on the balance sheet. And that includes the Human Capital Reporting Initiative that CalPERS has played an important role in. So I think the question, I think another thing that came out of the hearings was a recognition that the private markets do not have the same regulatory requirements, but there is a case, some argued to the hearing, there is a case that the SEC's remit needs to be extended further. And you'll see that in the last round of regulatory expansion, private equity firms, hedge funds came under the umbrella of SEC regulation, which is one step in that direction. But right now, there is, as John said, a quiet life if you're in the private markets, but there is also some concern to ensure that private markets get better regulated because a growing part of the economy is growing there.
And just to follow up on your point about the reluctance or the delay in going through an IPO process, that may be encouraged by the ease of getting financing because of the easy money we referred to earlier when Hero was here. There's an enormous amount of money sloshing around the world, and it is, if you don't have to go public and you can get financing from private sources, right. The question is, why would you bother going public? It exposes you to all kinds of things that you may not want to deal with. And in fact, that could be a serious issue that might be, I don't know how you solve that without going through the trauma that we started to go through last year that Cheryl referred to, and I'm sure has happened too. Dan, you had a point too.
Yeah, I think it's a terrific question, Mr. Jones, and the only comments that I would underscore is that it is a global phenomenon, but it's especially pronounced in the United States, and I would say less so developed international and even less so emerging markets where even you're not seeing nearly the level of shrinkage. It's also worth mentioning that there are fewer companies public, but they are larger companies. So the capitalization of the markets has actually grown significantly, but it's just concentrated in fewer companies. That said, the growth of the private markets relative to public markets is really where we're talking about. And, in some of your, I think it was Andrew that mentioned yesterday just how much dry powder is on the sidelines around private markets. Mm-hmm. This is one of the reasons why we're so focused on finding a way to deploy more capital into the private markets is that, historically the Apples and the Oracles and the Genentechs went public as very small companies. Now these companies are staying, and so as an investor, as a public markets investor, you got exposure to the really early growth of those companies. Much of that growth is now happening while it stays in the private markets, which again is a rationale for our desire to really deploy more capital, but in a thoughtful way in the private markets.
Yep.
Mm-hmm. Good. All right, let's move on here. Good.
Now,
I'm sorry.
Yeah, no.
Another question.
So the bottom line is using Ben's analogy is that where are we on the wave? Are we at the crest where it's time to get on, start moving from global equities in a more strategic and advanced way, or do we kind of wait, the wave hasn't reached the crest yet, and just kind of stand back and monitor?
I think our thought on that really is thinking more, first of all, more creatively about not thinking so much on the asset class and thinking more about the exposure that we're trying to get. So for us, this is a lot of the work that Ben's been talking about around harvesting equity, public, private. It's when you think about the exposure you're trying to get, you're exposing yourself to earnings growth, you're exposing yourself to economic growth. So really, we want to be thinking about equity and then thinking about, if we believe the growth will be more on the private markets, it's thinking about how we position the public markets to kind of be a liquidity source in some sense, which again is a lot of Ben's focus around this liquidity dashboard, and really thinking about how we generate liquidity. So I think the wave that we're looking at is that we think there is more to come from a migration of capital from public to private, and that's why we really want to position ourselves to get more in private.
Just on that note, we are privileged CalPERS because who we are, our size and brand name really help us get access to the top private equity managers. So not everyone equally share that privilege as we do.
Mm-hmm. Right. So this chart shows you a very long, this is again from Triumph of the Optimists originally, but the data is updated yearly by Credit Suisse, who's their publishing sponsor. But it's an interesting chart because it basically shows you the gross return on equities versus other asset classes. Bills, bonds, and inflation are the other measures against the equities. The equities in the left-hand chart over that period of 1900 to 2018, I believe, or 17, is in fact 9.4%. If you look to the right, you see it minus inflation, and it's actually 6.4%. So it's really quite astonishing. It's a somewhat sobering chart in my mind, because in fact, over very long periods of time, if you really want to talk to somebody about being a long-term investor, 120 years isn't a bad place to look at. Yeah. And in fact, in those numbers are some markets that collapsed and disappeared for periods of time, including Germany and Japan, of course, during the wars, and in some other markets as well. But in fact, there is a huge gap because of inflation, and inflation is a sort of an insidious risk that you have to take account of in any investment strategy long term. This chart to me shows you that. So it is a somewhat sobering statistic. It goes from 44,000 to 1,500, from nominal to real.
John, can I make one more comment?
Sure,
just if you go back to slide 9 really quickly, it's just worth mentioning really quickly.
9?
Yes, please. John said a couple of times, and I think it's worth underscoring, thinking as a long-term investor. Note that if you look at the United States, and the end point of this chart is from 1900 to 2010. So that 2010 end point is after a 30-year bull run in the bond market, right, where interest rates went from the mid-teens down into the low single digits, and right after the financial crisis where the equity market was at a low. And still, you can see that with the United States and with all the other countries also, that equity still vastly outperformed bonds. Now, bonds are a really important part of a diversified portfolio. Jeff talked about that last week, but it's also important that we continue to expose ourselves to equity, because that's where the larger returns can be gained, though, with the volatility. So I just thought I would mention that even with that endpoint, thinking like a long-term investor is one of the real advantages that CalPERS has. But again, long-term is a 110-year perspective.
And the challenge with equity in the long run, if you can stick to it, the history proves that it does deliver the premium over bond. Mm-hmm. The challenge is the volatility, the drawdown risk. And that's why the investment office is so focused on managing the drawdown risk when the next crisis comes, so that we can continue to benefit from the equity premium. the return in equity premium. So these all ties together why, as Dan mentioned, that we're so fixated on having a plan, liquidity dashboard, to protect ourselves against from the next drawdown. And in the meantime, we try to explore all the ways that we can benefit, we can expose to the equity exposure, let's be public equity or private equity.
All good points. Other questions? Okay. So this is from your own statement about global equity. It's worth repeating. The primary role of equity is total return oriented and to capture the equity risk premium defined as the excess return over risk-free government bonds by means of ownership risk in companies and exposure to corporate earnings growth. The major driver is appreciation with some cash yield growth and liquidity. And that's from your website. A very good statement. Probably more technical than most people would understand, because the equity risk premium is a calculated number that basically looks at the advantage of equities over a risk-free rate, which is usually the one we use is normally is Treasury bills, basically, which is considered risk-free because the collapse of the United States would have to happen before they would be not able to pay it off. So they, yes, are very low right now. And in fact, could go negative at some point, I suppose. So then, but the fact is that there is almost always a advantage gap, the risk premium that you take to go into equities, and that's what you're trying to harvest when you're going into global equities as well. You're looking for those premia across the world when you're a global investor. You can look at them in the U.S. and look at them internationally. But to go back to Henry's question. Looking at global, one of the answers might be why you stay with it is because you don't know which ones are going to be moving in and out of the advantageous cycles, but also it gives you the chance to look for those premia where they exist. And you may see different ways of taking advantage of those available risk premia that occur and even trying to produce better returns through either leverage or arbitrage strategies. You use alternative beta in your portfolio to some extent to do that. So it's an opportunity set that is not available when you stick with your home market. You want to stay well positioned to take advantage of opportunities wherever they occur in the world. This is a good statement, as good a statement as I've seen anywhere, actually, in the institutional market. So why, again, you're looking for price appreciation, cash yield, dividends, but primarily it's the capital gain, the price appreciation that you're really after, in most cases in equity. Risks, I'll be clearly economic risk, high sensitivity to global economic growth, and also anti-growth. If you have 08, 09, again, it was tough to stay with your equity allocation, and a lot of people didn't, much to their chagrin later on, particularly if they were, quote, long-term investors. You clearly have to worry about liquidity. Portfolio has got to remain highly liquid, particularly when you're paying out the size of payouts that you do. So clearly you've got to figure that out, but that's also another reason why you have fixed income and other liquid sources.
Do a question from Ms. Taylor?
Yes, thank you, Mr. Chair. Thank you very much. When we get to risks, you have high sensitivity to global economic growth variability. What does that entail? Does that entail the global outlook in terms of geopolitics? Does that include our ESG, sustainable development goals? What does that include? Is that just a very narrow, it's only about economic growth?
No, it does include all of the above. What affects global economic growth, and that's happening now, can be any manner of geopolitical events and statements, and the tariffs, the trade controversies that we're going through now are really affecting economic growth globally. you're seeing growth slow down. People are worried that if the battle continues between the U.S. and China over that it will further affect growth globally. So you can't separate that entirely. There are obvious ones, there are less obvious ones. Clearly, there are industries which are growing sort of organically and others that are declining organically for reasons that they don't have the economic reason to be any longer. It's kind of the buggy whip argument.
Right.
As AI takes over, information sources are going to change, and the generation of information will change. It's extraordinary. You see that actually in the investment business. That investment business is changing because big data comes in, AI, machine learning are applied to that data, and the decisions made by the portfolio managers are made in a different manner than they were 20 years ago. It is changing. It's changing the environment. And the skill sets that you're looking for in your new employees are different than the skill sets you were looking for even 10 or 15 years ago.
And so then consider that in the financial market, and I noticed it was spoken before in our previous class with AI and everybody taking account of this, and I don't know that our job as pension investors is particularly, but we need to be concerned about this gig economy kicking up, the AI replacing workers, or displacing workers. What are we helping the capital markets face this, through our own investments, or are we sort of sitting by and watching it happen and hoping the capital markets take account of our possibly very, very soon displaced workers that in consumer America, that makes up a lot of what our GDP is. So.
Well, all I can tell you is I do a lot of work with universities. They're facing the same question because they're seeing a demographic dip in their student population now, and they're saying, how can we train and educate the next generation of students and to become part of the workforce? That is a big question, and it's a very good question. No one has a clear answer to it yet. A lot of optimists are saying, even with the growth of robotics, AI, machine learning, et cetera, there'll be plenty of jobs.
Not sure about that.
But the jobs will be different.
Yeah.
Kids now are being trained by universities in coding.
Yeah, but not everybody can be a coder.
Not everybody can be a coder. That's right. But there will always be need for communication, for clear thought, common sense, all those good things that liberal arts teaches you. And I speak to a lot of university boards and do some consulting with them, and that's always an interesting question to get into, is how is that university or how is that college or school adapting to the new realities, and how do they incorporate that into their curricula? There's no
It just
easy
seems
answer.
to me that it's something we need to be forward thinking on as an institutional investor that does invest in the entire index. I think it's very important that we find out a way that we can help folks look at this. I don't know.
I'll just
think
make
it's really important.
I think it's a great point. I'll make a couple of comments. First to your most recent question, and then also to your previous one, because they're both great questions. With regard to AI, Beth and her team, and she did a collective process around the investment office, but she did a whole project recently. One of the two main research projects she did in this most recent fiscal year was on disruptive technology, and AI was certainly a portion of that. So it is something we're spending a lot of time thinking about. There aren't clear answers. But it is something that is critical, and it will have an impact. On your previous question around economic growth, this is one of the reasons why we spend so much time on thinking about the economy and having John Rothfield here and otherwise. When you think about equities, ultimately the way that equities make money is off of earnings. And earnings, right? I mean, an equity, as John said earlier, is a pro rata ownership in a company. Earnings are what drives the value of that ownership, right? That company's ability to earn money. those earnings are based on economic growth, and this is all these things that you're talking about. Whether people have money to spend, whether consumers, whether there are new productivity things that drive the economy, and all of these things, whether it's ESG and otherwise. And I couldn't agree more with what Hiro was saying earlier. That this is why for us ESG is an important factor. We look at it through the lens of an investor. It's about how is it going to drive earnings growth and otherwise, but it will result in impacts on our investment return, and that's why we need to be thoughtful in this space.
Thank you.
So let's take a quick look at your total fund allocation. You can see global equity is 50.2%. Fixed income on the left, 28.7%. Private equity, 7.2%. So in fact, equity, and you have real assets, 11%. So a good portion of that you could consider equity, but it may be both. In fact, you are heavily allocated to the equity side of the fence, and that's really what you see in most large institutional investment portfolios, because they have been trained to look for the opportunities for growth. And you need to do that if you're going to keep the contribution of the investment fund to the income you need, liquidity, et cetera, that you need to pay your beneficiaries.
Yeah, I just add one comment to it. You often hear the term 60-40. So our portfolio refers to 60% equity, 40% fixed income. So if you look at our portfolio allocation now, it's not that different from 60-40. So we have global equity. If you put global equity and private equity together, it's close to 60% of equity exposure. And if you think of our real assets, our objective or mandate over the real asset program is core, U.S. core. So that acts similar to a fixed income. So if we add our fixed income and real asset allocation plus liquidity together, it's about 40%. So our portfolio is quite similar to 60-40, that what you often hear in the media and in the context in your conversation with other peers.
Right. So the global equity investment philosophy of CalPERS is really, they are very difficult to predict. We've talked about that. The alpha opportunities are multifaceted and time varying. They do change, so you have to be very nimble if you're going to invest globally, particularly in emerging markets where you do see more volatility and more cyclical shifts. But you can take advantage of that as well. There is a good portion of the job of global allocation, of global equity investing, which is looking for opportunities in terms of cyclical changes which occur. Focus finally on holistic portfolio net of costs, and just mentioned 80% of the portfolio invests in cost-efficient, internally managed strategies. Now I'll let Ben and Dan talk a little bit about that, why that's the case.
Yeah, so I leave the cost to Dan, but I'd like to comment a little bit on the alpha opportunities. Mm-hmm. So if you look at the four major asset classes we invest in: global equity, global fixed income, private equity, and real assets. One can argue that most efficient market is global equity. So the alpha opportunity in the most efficient market, the alpha opportunity, I would say, not just time varying, is to a certain extent is elusive. So capturing the alpha in the most efficient market segment is very challenging. So instead, we focus on, or at least our plan in the most efficient markets, we try to focus on the controlling the risk with the tracking error and then reducing operation cost. So on the cost part, I will leave to Dan.
Yeah, so this speaks to Ms. Oliveira's question previously around some of the questions on fees. For an organization that's largely externally managed, that cost structure is more difficult. As we said, with 80% internally managed, it gives us a real advantage. And the whole global equity portfolio runs at about 8 basis points, and that's been on a downward trend from maybe mid-teens, actually maybe in the 20s when I got here, to down to into the mid-teens, and now, as I say, into 8. And I think we're on the path to. I don't want to set myself up, but my goal would be in the next few years to be down into the mid to low single digits for global equity, and that's what we've seen from a standpoint of our trajectory. Because, investment belief 8, which is one of our 10 investment beliefs, we know that the opportunity for alpha and markets will bounce around, but costs are always a headwind. They're always a negative, and so we manage those very closely.
And you've been very successful from what I've heard and seen, read and seen in your literature, that in being able to reduce those costs. In general, by the way, the investment business, because of the growth of passive investment, index-based investment, whether it be index funds or ETFs or highly cost-efficient vehicles, those have been aided by the bull market we've been in for 10 years, no question. And investors are saying, why should I pay 30, 40, 50 basis points or more for active investment when, in fact, they've been losing to passive investors? They're really talking about equities because that's the most efficient market. In fact, though, that trend has been affecting everything in the investment business. It's been shrinking the business to some extent because it is no longer on long-only strategies like U.S. equities, no longer a viable business to be an active manager unless you've got some edge, you've got some distinctive way of making money so that you're attracting new business. Not happening.
Yeah, so on the note of the cost, I just would like to compliment our investment office. Close to 80% of our asset managed internally, and we have been running one of the most efficient asset management from Dutch perspective, cost efficient. As Dan said, that global equity program is only about 8 bips, and we are still, we're not stopping there. We're still finding ways to reduce that cost. And in real assets, Paul Machaka can tell you, we're trying to we have changed our business model for better control and lower cost. And then again, the innovative ways we're trying to explore in the private equity, the Pillar 3 and Pillar 4. One of the goals is to reduce cost and more transparency and reduce cost. So we're very proud of the efficiency the investment office is operating now, but we continue to look for ways to reduce cost.
Yeah, and I'm sorry, Ben, I'm really glad you mentioned that. Not to just single out global equity, because it is the case that some of you that have been on the board for a while remember that our cost structure was north of approaching $2 billion years ago. Now we're down in the sort of $1 billion range on total fees. And again, that's on an AUM that's much higher. Part of that is this focus on costs. The fixed income portfolio is over 90% internally managed, and I think that runs at, Arnie will have an update next month, but it's lower than global equity. I think it's down in the sort of 5 basis point range. Private equity's done a ton of work on this. Real assets, like Paul, as Ben mentioned, we're a lower cost than our peers and what the benchmark imputes. So lots of work on cost. It's been a critical focus across the asset classes.
Now, I think the private markets are an area where you'll see, as Bureau said, you'll see more work being done with innovation to get those fees down, so that you're aligning the manager, the GP's interests with the investors, with the asset owners, more and more. We may be seeing the last of the sort of the great halcyon days of private equity in some respects, but they're still able to make a lot of money staying shoulder to shoulder and resisting a lot of the changes that have been proposed.
A question from Ms. Oliveros.
Thank you, Mr. Chair. So as we talk about the basis points that are paid out to manage some of these funds, 8 bips is relatively low. When I think of how we would apply that fee externally, so if I was to go buy an index for the S&P 500 and pay 8 bips, that covers all of their operational expenses, right? So if we say that our cost is about 8 bips, does that cover our operational and investment expenses as well, like personnel costs, real estate, everything?
Yes, so there's a whole cost allocation structure, but we get a set of costs that from the enterprise that includes all the work of the rest of the enterprise. Mm-hmm. Then there's a cost of our own fees, which we do have some active management that includes fees. We also have some sort of model provision strategies where we're actually managing against a factor, but we do pay for that sort of factor provision. And then also our own headcount and everything else, technology, all of the above. So yes, that 8 basis points is a fully loaded number.
Great, thank you. I'd love to get more information on that.
We'll have more next month with the Global Equity Program review, and happy to dig in as you see fit.
Thank you.
Mm-hmm. Good. Did I miss a space? No. Okay. No, I think we're good. This is just some of the, we threw in some charts that are more sobering than others, but in fact, you have over a long period of time here, you've seen the U.S. clearly outperform non-U.S. stocks. It doesn't diminish the fact that the diversification benefit and the ability to find inefficient markets outside of the U.S. is very valuable to the global investor, but you have had a long period where the U.S. has outperformed. That has obviously benefited some people more than others, but in fact, you could, as you do see there, you do see periods where international stocks do better, or at least relatively, and then this, of course, looking back in the past, so you don't know what the future is going to hold. But clearly, you have benefited from being in this market where the economic growth has been extraordinary, and the equity returns have been extraordinary as well over a long period of time. The other side of that is that you do have more correlation between the two, U.S. and international markets. This chart shows you that. This is the top. The blue line is the U.S. versus non-U.S. stocks. The red line is U.S. stocks versus U.S. bonds. So there's a lot less correlation. And go back to Dan's point, Ben's point, that that's why you have fixed income. Because there is that lack of correlation that you want to count on, particularly when things get rough, like they did in 08, 09, when bonds literally saved a lot of people's bacon and provided the liquidity they needed to get through that. I can remember Harvard University having to go out into the public debt markets to be able to pay their staff during that period. It was very painful because they were subject to capital calls with their enormous percentage of private equity and venture capital, and they were really squeezed. They were in a liquidity squeeze. So good to have fixed income, good to have liquidity in different vehicles that you can count on if you do get into problems. But this shows you the change. It's quite dramatic in both cases of the correlations. Okay, did you have a point there? Okay. So let's talk about benchmarks briefly. I think Hiro covered benchmarks extraordinarily well in his remarks, so I'm not going to delve too deeply, but clearly you heard this from Jeff Bailey a month ago. He talked about the types of things that you want to see in a benchmark. You use a benchmark which is a customized benchmark from FTSE Russell, and I'll let Ben and Dan talk about any details here, in detail if you have questions on it. But fundamentally, these characteristics of benchmarks should be present. Everybody has to be understanding of what the benchmark is. And in principle, I just want to talk about that. We can talk a little bit about, by the way, that list of characteristics is in the primer for trustees that you all received. And if you didn't, we'll make sure you do, from the CFA Institute Library. It's published by the CFA Institute Foundation. But it's a terrific book for trustees of institutional funds. But all of these characteristics should be present in an index that you choose, a benchmark you choose. The custom benchmark, Ben or Dan, do you have any comments on this, or are there any questions on this? You've seen this before, so I don't want to dwell on it too long. But in fact, you've got a customized benchmark. Benchmarks are developed by really three primary producers: MSCI, FTSE Russell, and what's the third I'm thinking of? Not Bloomberg, but they have one too now. There's another large, I'll think of it in a minute, I'm having a brain freeze. No, there's actually a third one, but I have to think of it.
You're talking about the old S&P IFC?
Yeah, S&P. Thank you. I think the interesting thing here is the size of the United States allocation, if you will, in the benchmark reflects its capital, world capital market share. And in fact, if you'd looked at this, and I think you can on the FTSE Russell website, they have a bar chart of the original FTSE All World. It was called something different then in 1987. And in that one, U.S. was 37%, not 54%. And guess which market was 35% in 1987? Japan. And those of you who remember the automobile industry in the late 80s being taken over by Japanese Toyotas and Datsuns and Suzukis and so forth, they were ascendant at that time. But this does change, and of course the benchmark that you use to judge whether you're succeeding or failing versus a previous regime has to be thought of in terms of the economic shifts that are going on around the world. These numbers change, and your benchmark has to change. And you want to make sure that you, as a committee, are looking at the right benchmark.
So just on the left chart, back to early point John and I made, the United States, the percentage of global GDP is about 25%, but the percentage of the market cap share is 54%. And China is the second largest economy, called, depending on which measure you use, somewhere between 15 to 20% of global GDP. It does not even command its own category on this capital market. So that just shows that the share we invest in capital markets, and when we look at benchmark, we have to be mindful both of the GDP, the economic growth, and other depths of the capital market.
That's
and
true.
one other
Also,
thing I would add to that is also demographics, which is another important point, and
yeah, we've
Hero
got
referred
one
to
chart
earlier.
on that, but I'll comment on it a little
Yeah,
bit. But that's absolutely right.
It's another lens.
Right. But if you're interested in China itself and vis-a-vis this chart, there was an article in the Journal, I think, yesterday on China opening up its markets through the A shares primarily, which have been around for a long time for foreign investors. But clearly you have to be very aware of how to do due diligence in China versus other markets, because there's a whole layer of different control from obviously a political and economic standpoint than really almost any other market that you're looking at, certainly any other large market. And it's astonishing that you don't see, I was going to make a comment on that, but thank you, Ben. Astonishing you don't see China in that capital market list. But that's the fact today, and you probably will see it soon, I would imagine. So looking ahead, we've just sort of summarized some of the things that we've been talking about. We are seeing changes in the world economy, which are going to change the opportunities and the challenges in global equity investing. You're seeing slowing growth in the world's economies now for a lot of reasons. We talked about some of them. Flat or lower returns for global equities, that has been predicted for some time. In fact, the U.S. has been a surprise in how good our returns have been on average. Yes, you've had bumps like last year, but overall, this bull market is now the longest expansion in our history, and in fact can continue now as far as we know, but with clearly increasing risks in certain areas that you have to be aware of. And Hero referred to it earlier. One of the big ones is how long can the central banks continue this easy money rate suppression policy that we've been living under for 10 years now? And what is the ultimate risk of trying to normalize interest rates, discount rates, in the world economic and monetary systems? There are probably unintended consequences that we still haven't seen out of that whole regime. The future inflation and interest rates are uncertain. We don't have a way of predicting those particularly well, even though the central banks can forecast or can hint as to what their policies are going to do. You still don't know where exactly those are going to go. Central bank intervention may distort cyclical market cycles. It already has. It is certainly affected a lot of consumer rates and commercial rates of borrowing and lending that are both stimulative but also a little scary, because there is a shadow banking, unregulated pool of funds floating around that can be really opportunistic for companies to borrow or individuals, but also can be somewhat scary because you're not sure whether those are going to be withdrawn at any point or what the lenders will do if there is some sort of a break in the markets. Increasing geopolitical tensions, clearly we've seen that in the headlines. They may impact returns, obviously due to trade threat and tariffs. And of course, Dan mentioned demographic shifts. Let me just show you one chart that's a demographic chart. This shows you a projection out to 2100 of the demographics of the U.S. workforce. And in fact, you're going to see a steady increase, slow but steady increase projected for that by experts in the U.S. government. Basically, it's the population division, population projection division. If you looked at most of the major developed countries in the world, Japan, most of Europe, China too, you see that line from 2020 begin to go down in varying amounts very rapidly. So the aging, and Hiro talked about that extensively, so I won't go into it in detail, but when you see that around the world in the developed markets, it is a little alarming because, in fact, the birth rates in those markets have dropped to the point where they're not replacing the workforce. These are ages, by the way, workforce defined as age 20 to 64. So in many countries that are where the biggest economic activity is going on, their demographics are not favorable to continuing long-term to maintaining their workforces. It's a major concern on a long-term basis, and as long-term investors, I think it's one of the issues, one of the risks that you have to take into account. Where are you seeing those shifts occur more rapidly than you were anticipating, or where can you take advantage of that? It was interesting, I went to a conference in Tokyo a few years ago, and one of the presentations was by a professor who had developed an exoskeleton. I don't know if you know what an exoskeleton is, but if you think of a beetle has an exoskeleton. It's an external shell. In this case, it was a motorized, very sophisticated piece of equipment that an individual could put on, and it was almost like the Avengers. You could do a lot of things that you couldn't do. You had extraordinary strength, et cetera, because you had these little motors helping you move and picking things up and so forth. He developed that in anticipation of Japan's demographic projection because it would allow older workers to work. Now that's extraordinary, but it's a good small little example of what the innovation to try to deal with the aging population of Japan might look like, or anywhere else for that matter.
A question for Mr. Jones?
Yeah, thank you, Mr. Chair. Yeah, going back to your comment about shadow banking, is that prevalent in the U.S.? I understood that to be a problem in foreign countries, but is that a major issue in the U.S.?
I don't think so, but it certainly, based on the number of emails all of us get from lending institutions we've never heard of before, there's a lot of lending going on outside of banks. And we all know that troubled banks have been through coming out of the 08-09 period. I don't want to be alarmist, but in fact, there is a lot of money being lent by off-radar institutions and private individuals. A lot of the funding of startup companies done by angel investors now or very small private syndicates. And I think that, I don't know the size of that because it's not measured. But in fact, there is a lot of money. We know that because the central bank's been printing it for a long time. And where is it going?
Yeah, the only thing I would add is that there's a definitional question there, how you define shadow banking, right? I will say that a lot of the risk we think has come out since the financial crisis, where so much more regulation came into place around lending and things like that. But depending on how you define shadow banking, you can include even like hedge funds and things like that.
Dodd-Frank covered a lot of those areas clearly, and as I said, I don't want to be alarmist at all, but in fact, it's one of those things that you think about and you don't really know how to quantify, so it's difficult to tell. But there's evidence of lending going on and borrowing, and how much leverage is in the mix that we can't measure, and so what you can't measure, you can't regulate. don't know. But in fact, don't want to end on a down note, because we are out of time.
Oh, you can end with the glossary.
Oh, the glossary. Yeah,
Knowledge
actually,
is power.
I don't think we need to go through it page by
No,
page.
but I thought you could have a nice, cheerful slide up
Yeah.
for your final remarks. All of the mumbo jumbo that goes into talking about investment, we decided it was time to start breaking it down. We made this promise in another governance work stream to put things into plain English. So we've had a first crack at the back of this presentation, and you can tell us where we've got it right and where we've got it wrong. But it's part of a new practice. We want to start explaining everything. And if we can't explain it, we shouldn't have it on a slide. So that was the thinking
That's
behind having a glossary.
Yeah. One of the jobs that I had at Common Fund was to try to make the complex simple and express it in plain English. I was actually an English major at college, and how I ended up in the investment business was another story. But in fact, Peter Bernstein, who was one of my heroes in this business, was also an English major. I found out when we were talking at lunch one day.
He's the author of the book When Genius Fail.
Right.
So, and he's author of a number of books, but I think the most famous one is
Story of Risk and
Story of Risk and When Genius Fail.
Capital Ideas, a whole bunch of books. There are a number of people that I think define great thinkers in this business. I may be sitting next to one or two here, but in fact, Charlie Ellis, who wrote, I don't know if any of you ever read any of his books, but he wrote the famous book called Winning the Loser's Game. And in fact, it talks about, and Charlie is one of my good friends, but he drives me a little crazy because he ran the investment committee at Yale University for 17 years.
You know you're on record on YouTube, right?
Yeah, no. Yes,
Okay.
I do.
He's
But
been to speak to the board.
He's one of the great figures in investing, and in fact has talked about indexing probably ahead of anyone else in this country, and for all the good reasons you're hearing now. But he was doing this 10 years ago, more. But he ran one of the most successful active management groups, which was the Yale Investment Office, as head of their committee for many, many years, for more than 15 years. I think it was 17 years. And during that period, Yale was the top institutional investor globally for a long time. But he is a fan of indexing, which just shows you the change in how the environment in investing has changed over that period. But Charlie was one of the people who was predicting it, and his book, Winning the Loser's Game, which has come out in various editions, was predicting that, or talking about that. It was based on a tennis game, playing defense. I think we've exhausted everybody. But
No, well, might be time for some questions.
yes.
Are there further questions, Mr. Chair?
There are no questions right now, no.
Okay. Then I think we can conclude it there, but definitely, John, thank you very much
Thank you
for
very much for
joining
being
us.
here.
Thank you for your time.
We appreciate that. Anything else, Mr. Ming?
No, not from us.
All right, we do have one request to speak from the audience, a Dave Elder, but I notice he's not in the room. There he comes. Hurry on down, Mr. Elder. It's your turn. It's your turn, Mr. Elder. We have your handout already, by the way. Please identify yourself for the record, and you have up to 3 minutes to make your comments.
Any of these work? This one? Is that pressed?
They're on.
Guess it's working. Good afternoon, everyone.
Good afternoon.
My name is Dave Elder. I'm former state assemblyman. I served 10 years as the chairman of the PERS committee. I carried legislation setting up the pre-funding account for health benefits, and I carried a number of the bills, 2% at 55 retirement formula and 2.5 at 55 for correctional officers. So I had about 200 bills signed. I served as chairman of the PERS committee for longer than anybody in history. And I'm just saying this because there's a lot of new faces here for me. And I don't have any speech to make or anything. I just wanted to bring your attention to this. It's been handed to you. Harry Markopoulos prepared this report. It's 165 pages. This is simply a summary. And I would have provided the whole thing, but it would have cost me about $300 to have it copied, so I didn't do that. But in any event, I just wanted to bring it to your attention. I think if you have your professional investment staff look at it and analyze it, and then maybe you want to put it on the agenda for a future meeting in the near future, I would suggest, because GE went down in your portfolio by almost $7 million today. And so at some point, that turns out to be some real money. In any event, I just would suggest that perhaps this would be a good thing for your staff to analyze and be aware of. And I just think if you might want to get off the railroad tracks before this thing hits, because he's talking about the possibility of bankruptcy with respect to GE. And you have a lot of the bonds, although I couldn't figure out how much you have in bonds. I know it's a lot, because that's pretty much gilded, high-grade corporate. So you probably have a lot of it, but that will all, and it's probably, when you bought it, was somewhere above par, and it may not be there now. I couldn't find any quotations on recent quotes on GE debt, although there are pages and pages of, or columns and columns of them in the financial things like Barron's. I just didn't happen to have a copy of it to review where they are in relation to par. So I just wanted to just make you aware of this, you know. At least, you know, if anybody asks you about it, the press or whatever, you can say, yeah, we're well aware of it, we're analyzing it, and we're keeping an eye on it. And that's basically all you can do. You might want to invite Mr. Markopoulos to come out here and defend his report, which I would be a hell of a public service, because I think in person, and he's the fellow who outed Madoff, and he wrote a book, No One Would Listen. You may have heard of that book, and it took him, and Harvey Pitt, he referred all this stuff to Harvey Pitt, who is one of the critics of his report, saying, you know, he could have come to me. Well, it took 4 years the last time, so maybe we don't want to do it again. That's all I got. I'd be happy to respond to a question if you have any, but thank you. No question, but we thank you for the information. The staff will look at it, so thank you. All right, thank you. So before we close, I just want to thank staff for bringing some great speakers to us today for our educational workshop. Very good time, well spent. And thank you all very much, and thank both speakers for some great information. This meeting is going to adjourn. PHBC will begin at 2 o'clock.